Hey everyone, welcome back to Corporate Decoder. Today, Liminatus Pharma Incorporated LIM just filed their quarterly report, and I am seeing some serious cash crunch red flags. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is burning through cash and relying heavily on new funding just to keep the lights on, which is a classic sign of trouble. Alright, let's dive into Liminatus Pharma's latest financial report for the quarter ending the 31st of March 2026. This report is a crucial snapshot of where the company stands financially, and it is telling a story that investors need to hear. Looking at their balance sheet, we see a company with total assets of about $2.8 million on the 31st of March 2026. That might sound like a lot, but dig a little deeper and you see that most of it is in cash and some prepaid expenses. What is more interesting is how the liabilities stack up. Total liabilities as of the 31st of March 2026 are a hefty $2.9 million. This is pretty close to their total assets, which already means they are on thin ice. But the real kicker is that most of this is short-term debt, meaning it is due relatively soon. They have $1.4 million in short-term debt, and it is all owed to related parties. This means they owe money to people or companies connected to Liminatus. It is like borrowing from your own family to pay the bills, and it can get complicated quickly. Now, let's talk about their accumulated deficit. This is basically the total amount of money the company has lost since it started. As of the 31st of March 2026, this deficit stands at a staggering $39.9 million. That is a huge hole to climb out of. Moving on to their operations, the company is clearly not making money. They reported a net loss of over $1.1 million for just the first 3 months of 2026. That is a massive loss for such a short period. Their total operating expenses for the same 3 months were just over $1.1 million. So they're spending more than they're earning, which is a basic problem for any business. And that net loss of $1.1 million for the quarter is a wake-up call. It shows that on their core business activities, they are losing a lot of money. This translates to a net loss of 3 cents per S-share for the quarter. While that might seem small, it shows the consistent drain on their finances. This statement shows how their equity or the owner's stake in the company has changed. Over the 3 months ending the 31st of March 2026, we see significant activity. They issued over 13 million shares of stock related to an offering, bringing in $3.4 million. This is a way companies raise money, but it also means they are diluting existing shareholders, essentially making everyone's ownership percentage smaller. The net loss for the period, over $1.1 million, directly eats into their already negative stockholders' equity. By the 31st of March 2026, their total stockholders' deficit is negative $132,596. This means that if you were to sell all the company's assets and pay off all its debts, there would be nothing left for the shareholders. They are technically underwater. Now, let's look at where the cash is actually going. And coming from this is often the most telling part of a financial report. They used over $2 million in cash from their operations in the first 3 months of 2026. This is a huge jump from the previous year when they used about $159,000. This tells us their core business is not only not generating cash, but it is consuming it at an alarming rate. To cover that operating cash drain, they brought in $3.5 million from financing activities. This is mostly from that stock offering we just talked about. It is a clear sign they need outside money just to survive. Even with all that new money from financing, their cash balance only increased by about $1.5 million during the quarter. This means a lot of that new cash was immediately swallowed up by operating losses. The company describes itself as a preclinical stage biopharmaceutical company. This means they are still in the very early stages of developing their drugs, and they have a long, expensive road ahead before they can even think about making money from a product. The report goes into great detail about a business combination that happened on the 30th of April, 2025. This sounds like they combined with another company, which is a common strategy for small companies trying to get onto a major stock exchange like NASDAQ. And speaking of NASDAQ, they've had some trouble staying listed. There was a notice about not being compliant with listing rules due to delays in filing reports. While they fixed that specific issue, it shows there have been some operational hiccups. Even more concerning, in November 2025, NASDAQ sent notices again, this time about not meeting minimum market value requirements. Basically, the market does not think the company is worth enough to stay on NASDAQ. They have a deadline May 18, 2026 to fix this, or they could be delisted. This is a really serious warning sign. And as if that wasn't enough, in January 2026, they got another notice about not meeting the minimum stock price requirement. Their stock price has been below $1 for too long. They have until the 14th of July 2026 to get that share price back up. If they don't, they risk being delisted. This brings us to the February 2026 public offering. They sold shares and warrants, raising about $3.4 million. While this is a source of cash, it is a relatively small amount given their massive losses and ongoing cash burn. It is like putting a very small bandage on a very large wound. The company itself admits in their report that there is substantial doubt about its ability to continue as a going concern for 1 year. This is the most serious statement a company can make about its future. It means they might not be able to pay their bills and stay in business for the next year. Having just under $2 million in cash is not much for a company that lost over $1.1 million in just 3 months. Based on their current burn rate, that cash might only last them a year. If that, they mention they are an emerging growth company and can take advantage of certain relaxed reporting rules. While this is common, it can also mean less transparency for investors. Management admits that their financial statements rely on estimates and assumptions, and that actual results could be very different. This is fairly standard, but it adds another layer of uncertainty. They operate as a single segment, meaning all their business activities are grouped together. This is typical for small companies, but it also means there are no diversified revenue streams to fall back on if one part of their business struggles. They have a CD47 license agreement, which is part of their core business. They paid $1 million related to this in early 2026, which is a significant expense given their tight finances. This is where things get really interesting with a lot of transactions involving related parties. Many of their loans and financial dealings are with entities and people connected to Liminatus. They had these Felix bonds that have since been converted into stock, so no longer a direct debt issue. They have several loans from Valitudo Therapeutics LLC, some of which are past their due dates and are now classified as short-term debt. The company states they have agreed with related parties to defer repayment, but this still highlights their dependence on these internal sources of funds. Similarly, they had loans from E1 Comfortech Company Limited that were also converted into stock, and more loans from Prepaids Sciences LLC, again with some past due dates but with repayment deferrals, and loans from Hana Immunotherapeutics LLC, also with related interests and some past due. And finally, Amantes LLC loans, again with related parties and past due dates that have been deferred. It is clear that this company heavily relies on financing from parties associated with it. They also owe money to their executive team for compensation. This is normal, but in context with all the other debts, it adds up. This section clearly lays out their short-term debt. All of it is with related parties and all of it is past due. Although they have agreements to defer payment, it is a web of interconnected debt that needs to be managed very carefully, and it all adds up to over $1.4 million in short-term obligations. This part details their stock structure. They have common stock and preferred stock. The big news here is the massive number of shares issued in their February 2026 offering, which brought in money but significantly diluted existing shareholders. They raised $3.4 million from this offering. Again, this is a lifeline, but it also means more dilution for shareholders. They have a lot of outstanding warrants. These are like options that give the holder the right to buy stock at a certain price. When they are liabilities, their value changes can impact the company's income statement, and they have a significant number of these, both equity and liability classified. Here they discuss potential future obligations. They have a short-term lease for office space, not a big deal in itself. This is important. They settled a legal issue with Clear Street LLC, issuing 4 million shares of common stock in exchange for cancelling warrants. This settlement also dismissed 2 lawsuits. The company had a default judgment against them, which they then settled. This shows they have faced significant legal challenges in the past. There is a discussion about deferred underwriting fees related to their initial public offering. Part of this was settled with shares, and another part is still outstanding. This section talks about how they value certain financial instruments. Their warrant liability is valued using a level 3 input, meaning it relies on unobservable inputs and management's own assumptions. This is a less reliable valuation method, and changes in these estimates can significantly impact their financials. This is a look at what happened after the reporting period. This is where management gives their perspective on the numbers. They highlight their biopharmaceutical focus and the uncertainties surrounding their product development. They include the standard disclaimer about forward-looking statements, warning that actual results could differ. This is always a red flag though, as companies often use this to shield themselves from future performance issues. They compare their operations for the first 3 months of 2026 to 2025. The increase in expenses is significant, especially the jump in general and administrative costs. GA expenses more than doubled, likely due to the costs associated with being a public company and dealing with NASDAQ listing issues. R&D expenses also appeared in 2026, which is expected given their business. but it adds to the cash burn. Other expenses net decreased. This is mainly because they had less interest expense on related party notes compared to the prior year, which is a small silver lining but doesn't change the overall picture. Here, they explicitly state there is substantial doubt about its ability to continue as a going concern. This is the most critical takeaway from this entire report. They are burning through cash, have massive accumulated deficits, and are heavily reliant on continuous financing. The cash flow statement confirms the dire situation. Operating activities are a huge cash drain, and they absolutely need financing to stay afloat. This section on their internal controls is very revealing. They admit to material weaknesses in their financial reporting. This means there is a real possibility that mistakes in their accounting could go unnoticed, leading to inaccurate financial statements. They specifically mention a lack of a formal control environment and inadequate segregation of duties due to their small staff size. This is a recipe for potential accounting errors. Essentially, they are admitting they do not have strong enough systems in place to ensure their financial reporting is accurate and reliable. They are taking steps to fix this, but the fact that these weaknesses exist at all is a major concern. They state there are no material legal proceedings. This is a positive, especially given their past issues. They are a smaller reporting company, so they don't have to provide the same level of detail on risk factors as larger companies. However, the issues we've already seen, like NASDAQ compliance and their going concern status, are huge risks. This lists various supporting documents. The certifications at the end from the CEO and CFO are standard. And finally, the signatures of the CEO and CFO confirming the accuracy of the report to the best of their knowledge. Looking at Liminatus Pharma's report, the story is clear. This is a company in a very precarious financial position. They are burning through cash at an alarming rate, have a massive accumulated deficit, and are heavily reliant on external financing, often from related parties. The NASDAQ delisting warnings and the confessed material weaknesses in internal controls are serious red flags. While they are in the early stages of drug development, which is inherently risky, their immediate financial health is the biggest concern. Without a significant influx of cash on terms that do not further dilute existing shareholders or increase their debt burden unmanageably, their ability to continue as a going concern for the next year is very much in doubt. This echoes the struggles of companies like Bed Bath & Beyond, which also face significant going concern issues before their eventual restructuring. The risk I am watching is their ability to secure long-term funding and improve their financial controls before they run out of runway. My biggest concern is the combined effect of their high cash burn, significant debt, and NASDAQ listing pressures, which could lead to a severe devaluation or even delisting. What I am actually looking for is a clear path to profitability and robust internal controls. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button helps, and subscribe for more deep dives. Join our Discord community, linked in the description.